So this is now topic 2, bond valuation. So just after the time value of money, you have to cover bond valuation. Okay, so just an intro. What is a bond? Yeah, a bond is simply a long-term loan. That is what a bond is. It's a long-term loan, and companies usually issue out bonds in order to raise funds. Yeah, for example, they would say they would issue out maybe a 1,000 bond, and what will happen is that they will invite investors to come through and pay up a 1,000, and then they set up an agreement with that person who invests in that money, and then they will agree that they will be paying back this person that invests the money a certain interest rate, maybe annually, until the end of the bond. So as I said earlier on, it's like a long-term loan that companies actually issue out. So it's like the company is looking for ways to raise money. It has maybe a project it wants to build, and now how does it get the money? And sources are difficult to find. So what a company does is that it issues out bonds, and by doing that, as I said earlier on, they would maybe say maybe okay, 100, maybe 100,000, and then they say okay, this investor takes 100,000 to the company, and then they agree that okay, they will be paying him back, this one who's helped them with the 100,000, at a certain rate. So that is why we now have to discuss about bond valuation as well, and see how it is done and calculated as well. So I won't go very much into detail, into theory, yeah, but as I calculate, I'll be explaining some things that are important to know about bonds. So first of all, some terminologies you have to be very familiar with in this topic are coupon rates. So the coupon rate comes in form of a percentage. As I said, you agree on a certain amount that they will be giving you. That is maybe yearly, monthly. You decide as the company and the investor. So it's given as a percentage, and it acts. Acts as it's like the interest payment you'll be receiving on your investment through that bond. Yeah, they'll be paying you through that bond. So coupon rates is just like another term they use to illustrate those interest payments that the company gives you as a return on the bond that you had actually acquired from them to help them finance whatever project they have. Yeah, so we will talk about coupon rates. We talk about another term we use is par value. So what they mean by par value stroke, they even say face value. These two terms just mean the original price of the bond. Yeah, that's what they mean by par value. It's the original price of the bond. So if they tell you 1,000 par value, that just simply means this is the original value of the bonds. No overstatement, no profits added, just like that's the original value of that bond. That's par value. Another term you need to be very much aware of in this topic is maturity date. What is maturity date? Maturity date is actually the last day on which the bond should be paid off, or the final date in short. So if they say 10 years, for example, 10 years, this bond is due for 10 years. So meaning after 10 years, they should have been done paying you off those interest payments. And then it would have reached the maturity date as of that time. So those are just terms you need to know. They'll be used very much in this topic. So it's best to get well conversed with these two terms. Coupon rates, the par value, and also this third term, maturity date. Yeah, so now let's get into it and see how bonds are computed using calculations. Yeah, so what happens is that some few things to take note as well is that when you have, they will give you a certain interest rate on the market. They will even specify the market interest rate was so much. So they might give you maybe, let me just abbreviate it as MKT, meaning market interest rate. The market interest rate. Maybe they might give you a certain percentage rate, and then they also give you what? A coupon, certain coupon rate in the same question. So get these two clear. The coupon rates percentage that is given, mind you, they are all percentages. So the coupon rate percentage that is given, it represents the percentage of the payments they are giving you as payback on the bond. Then what about this other rate? This other rate is just like the rate on the market. It's very key when they're computing bonds because it helps them also take into consideration what the as well the time value of money. Yeah. So if you've noticed, we learn topics for a reason in corporate finance because they build on. That's the thing. Yeah. So this coupon rate, as I said, is just representing the payment that the company owes you that they will be giving you at a fixed period of time. So a coupon rate is a fixed rate and they will be giving you a fixed amount at a certain time period until maturity date. So let's look at the formula they use and I'll illustrate how all these two play a big role in this formula I'm going to show you. So the formula for calculating the value of a bond, because you have to calculate the value of a bond. So VB represents value of a bond, which is equal to so this is the formula. VB, value of a bond, is equal to I. What does the I stand for? The coupon interest payment. Then what's in the brackets? PVIFA. I'm sure these terms are now looking familiar now that you've gotten some idea on what time value of money is about. This stuff in the brackets will now be at least a bit familiar. You put that PVIFA in the brackets, then add MV. What is MV? Maturity value. Multiply it by PVIF. Sorry for the side, I think it was just a space there. Yeah, so it's supposed to be in one line. That's the formula for calculating the value of a bond. So the I actually is as we said, it's the coupon interest payment. So as I said, they'll always give you what? A coupon rate in form of percentage, but you have to convert it in kwacha form because that is what you substitute in this formula on the I part. And then inside the bracket, you've seen PVIFA, right? It simply means present value interest factor of an annuity. Why do we use present value in bonds? Reason is that bonds are discounted to the present. It's just a rule. Bonds have to be brought back to present date so that someone knows today what they should pay and how much their value of the return would be. Yeah, that's why bonds are always discounted to today, the present day, and that is why we use the present value only in bond valuation. We never use future value. Yeah. And why annuity? We've included an A. Why present value interest factor of an annuity? Remember I said in the video that it's a fixed payment paid each and every, maybe each year or each month. So if you hear words like that, each, it's an annuity, as we had denoted in the time value of money. And that's how we apply those concepts and bring them back here as well. Then we said plus MV. What is MV? MV is the maturity value. So this thing you've seen, maturity value, it's the same meaning as this word I'm writing below, par value. So they interchange these words. All you just have to do is that you just have to memorize all the terminologies they use. MV is maturity value, par value, same meaning. Yeah. So I'll give you an example and this will make sense. And then we multiply the MV by PVIF. It's equally present value, but we haven't put a comma A at the end, right? Showing that this maturity value is not an annuity. It just comes on the last day. Yeah, it's just valued on the last day, so it doesn't come each and every should I say every time of the period. Yeah, that's the MV part. So let me now show you an example in just a few seconds. Okay, so imagine you've been given this example. They tell you the coupon rate is 6%. The market interest rate, let me just abbreviate this, MKT rate is maybe 8. Then they tell you the par value of the bond, they would say maybe 100,000 par value, sorry, 1,000 par value. Okay, so they give you a scenario with this information: a coupon rate of 6%, market rate of 8%, and 1,000 par value. How do you work this out? So what actually happens is that when you get this information, they give you like this. You want to compute how much they'll be giving you on a, should I say, a yearly period, and then maybe they even tell you that this bond is due for up to what, 10 years. They even say this. So you want to know how much they'll be giving you each and every year until the 10-year period elapses. So the coupon rate plays a role because that one represents the fixed payment that is due to you, as has been mentioned earlier on in the beginning of this video. So you say 6% of what? Of the 1,000 par value here. Let me just erase this so that I can write properly. Yeah, so you say 6% of the 1,000 par value bond, because it is the bond that they are giving you which is valid, which is priced at 1,000 par value, and to know how much they'll be paying you, you use the coupon rate because it represents how much they will be paying you on a fixed installment. When you do that, it should give you, I'm sure, 60%, if I'm not mistaken. 60 kwacha, sorry, 60. So now that you've denoted how much in kwacha they'll be actually giving you, then you now go back to our original formula, the one we put there if you rewind in the video. So the formula again was VB, the value of the bond, is equal to I PVIFA given a certain rate and a time, plus MV, open brackets, PVIF, R and T. So what do we substitute on I? If you remember again earlier on in the video, we said it is the should I say the amount in terms of money of the coupon rate, and as we've just calculated, it's giving us 60 kwacha. If we say 6% of the 1,000, which is there 60, you substitute. How about in the brackets PVIFA? These are those tables, the interest factor tables that you have. You look at the interest factor, specifically the present value interest factor of an annuity table, and there you look for what rates, because you would be wondering what rate are we using. That market rate which is given in the question is what helps you denote the rate you'll be using, because the rate that they will be the rate that they will be using when calculating the value of the bond is the market rate. So they said the market rate was 8, if you rewind in the video, 8, and the time period is 10 years. So it's like you go and search for that on your table. You say that, and then you put the comma 8 below there and the time period of 10 years, right? And you search for 8% and 10 years and find the PVIF value there, and you substitute in the brackets. So that's how it works. Plus MV. What is MV? MV is the maturity value. Well, if you remember, I told you the two terminologies. Maturity value can also mean what? par value. And they told us earlier on in the data given that the par value is 1000, and that is what goes here, plus 1000. Then open brackets, what did they say? PVIF, given a certain rate and time. So same story. This time around we are not using the annuity table, but we're using the present value interest factor just there. Do not include the annuity on this one this time around. The rate is the same, mind you, the rate is the same, keep the 8%, and the time period is equally the same. The only difference is you're using what? A different table, not the annuity one anymore. On the one you multiply on the 1000. So once you do that, you locate in your table and then you compute. You get your value of the bond. So I'm sending another video on tips now on answers you'll be getting and what that kind of bond is called. So this is just the first video. So now some tips on bond valuation, certain things you can know so that even when you're solving, you know that okay, the answer I'm going to get, it's correct. Yeah, so as we talked about earlier on, market interest rate is mostly given as well in a question, and also coupon rate as well is also given. So one thing to know is that when you're calculating the value of the bond, both of these two are inclusive as seen in the earlier video, the first video on bond valuation. So one thing to just know is that when your MKT rate, which is the market rate, if the market rate is greater than the coupon rate, let's start with this scenario first. If the market rate is greater than the coupon rate, for example, market rate is 14%, coupon rate is 6. That's what I mean by greater. Yeah, so what happens to the value of the bond? Will the value of the bond be bigger than the par value or not? Remember, the par value is the original price of the bond. Yes, but one of the video had explained this well. Yeah, so for example, they told you the par value was maybe 1000 as earlier explained. 1000 par value, the original value of the bond. So for example, if the market rate is now greater in this scenario, it's greater than the coupon rate, do you think the value that we'll find will be greater than the par value that the bond will start with, the original value? The answer is actually no. When the market rate is greater than the coupon rate, the value of the bond is actually less. It's actually less than the par value. So these are just like some tricks to know, so that even when you know you're computing your figures and you find that okay, I've gotten a certain answer, you're even sure that it's correct, because this is what happens when the market rate given in the question is bigger than the coupon rate given in the same question. Most likely the answer you're going to get when you compute your value of the bond, it will be less than the par value. So for us, this practice sake, you can test this set of information. Imagine you've been given data of as follows. Maybe the market rate was let's say 15%, the coupon 6%, and you can have also, should I say, the time, maybe they tell you 10 years again. Then they even tell you okay, the par value of this bond is, let's just use the 1000 as well. Yeah, 1000 par value. And as we told you, par value also means what? MV stands for maturity value. So these are just terminologies to know. Another one I can add on this par value, another way they would use is what? FV, which is the face value. So these three, they all mean the same thing. They just use them interchangeably to just test your understanding, yeah, on questions. So you might have that set of data. If you test this, the answer you're going to get, trust me, the value of the bond, it will be less than 1,000. Why? Because the market rate is greater than the coupon rate. That's what I meant by that first scenario or statement. Then, if your market rates, this time around your market rate is less, if your market rate is less than the coupon rate, most likely your value of bond is greater than the par value of the bond, or the original price of the bond. So these are just the two scenarios that can occur, and it's you to now know these two tricks when you're solving. They're just a tip for you as a person solving it. Okay, when I have this solution, I know that, okay, at least I'm in line, my answer should be correct. Yeah. So like as we said, you might be given that same maybe 1,000 as usual. Again, trust me, this 1,000 is just an example. They can give you any other value which can represent par value. Maybe let's say they can tell you maybe 5,000 par value. Yeah. And then they give you the same details, maybe the MKT rate. Maybe this time the MKT rate is 8%. The coupon is big. Maybe let's put it at 10. It's bigger because we're looking at the scenario where the MKT rate is less than the coupon rate. And maybe 7-year period, they give you 7 years to do this. So you'll find that the value of the bond that you get from this set of data this time around will give you a higher value of the bond, and that's what we mean. Yeah. So these are things to take note even as you are solving. So when a bond, then the value of the bond, when the value of the bond is lesser, when the value of the bond is less than the par value. For example, it gives you, maybe the value of the bond comes out as maybe 700, right? And maybe someone told you that, okay, the original price or the par value was 1,000 par. It's less, as you can see. Such a bond is what they call a discounted bond. A discounted bond. That's what they call this. Reason being is that it has come out less than the original value, so it's called a discounted bond. Then a bond, so if the value of the bond comes out greater, for example, maybe 1,200 kwacha, and then they told you maybe the original was maybe 1,000, maybe 1,020 per value, something like that. Yeah, you find that it's greater, the value that comes out. So if the value is greater, this type of bond is what they call a premium bond. Premium bond. So take note of these two. This is what we've talked about. A discounted bond, the one which is less than the par value, and a premium bond which comes as a result of being great. The value of the bond is greater than the par value. So most of the time, as Elia said, companies use bonds to try to finance. They like borrow from investors. Someone will come through, get a bond from them, and by getting a bond, it's like they would have offered the company a certain amount of money, and then the company will now be paying that person, the investor. So a company prefers discounted bonds. Why? They will pay the person back less. If you've noticed, they'll pay the person back less of what he was originally told to pay them. It's because the market rate maybe has fluctuated. That's why it ended up happening that that person gets a lower value of the bond at the end of the day. But premium bonds, again, is a plus on the person that gives the company money, in that he's going to get back more than what he had originally given them. So vice versa, if you've noticed, one side is also good, and as well, it's bad again in this. So again, for the company, if we look at premium bond, it's also not so good for them, is that they'll have to end up paying more. Yeah, they end up paying more than what they had given this investor. Yeah, But all in all, bonds are just used for a company to raise funds and work on their projects. A scenario that can also happen, the market rates can also be equal to coupon rates. It's very possible. The market rate is equal to the coupon rate. What happens to the value of the bond in this case? The value of the bond comes out exactly equal to what? The par value. So it would be like the value of bond is equal to what? The par value of the bond. So if it was 1000 par value, the value of bond would be what? Also 1000. So such a bond just comes out exact. You'll pay back exactly what you had invested in them. Yeah. So those are a few things to take note, the tips to remember in bond valuation. Otherwise, next, should I say the third part video, come and talk about the yield to maturity.